Hey, welcome to the podcast, everybody. Thanks for joining me here on this Monday. I hope you had a great Thanksgiving, nice extended weekend. We did have a short trading day on Friday, Black Friday. Markets were open till noon Central Time, and obviously some light volume on Friday. And really, I expected an up day on Friday, given how oversold we were coming into Friday. But the market was up. I think it was up about 100 on Friday at one point, and then finished down, about 40 or 50. But then we came back today, and I would have preferred to have the markets down a couple more days, and we'll get into that in just a minute on why it would have been an even better setup than having a rally today. As you can see, the Dow Jones was up about 291 points. It was off of its high, and actually was up about 230, 240 going into the final few minutes, and then the market rallied about 50, 60 points, and really the last few minutes there. Transports were up 3.5%. Really everything that had been beaten up was the thing that was up the most today. Of course, financials up 3%. The NASDAQ, the Russell 2000, up almost 5%. Oil service sector index up almost 4%. So broad-based broad-based buying across the board. It came on a rumor that the IMF would be helping Italy out. And again, it's another one of these rumors that gets the market going. And that rumor was even watered down a bit and dampened just a tad in the middle of the day. Yet it didn't matter because the markets were so oversold that we got this a nice bounce back. I'm going to start off with the S&P 500 today, and you can see, after we broke out of this trading box that we'd been in for most of August, of course, had that breakdown in October, very sharp rally starting the beginning of October, intraday reversal, all the way up to the top, had a little trouble getting out of this box, broke up to the 200-day moving average, and then we had this wedge that developed, and normally those are continuation patterns, so we had this nice run in October. We get this wedge beneath the 200-day moving average, and you expect that the market may break out to the upside. The only problem was that we still had a lot of under the surface weakness in the markets. Not only is there fundamental weakness, pessimism galore, and all these failed, the supercommunity failing. It really started to look like late July, early August when the markets fell so hard. But the internals of the market were so weak, so we didn't break out to the upside. In fact, we broke down to the downside. I think it was the worst Thanksgiving week since 1932 as far as stock market performance. That's going back to the Great Depression. So really a nasty week coming into Thanksgiving week. Now, at the beginning of the podcast, I pointed out that I thought we should have, or would have been nice to have, a couple more really down days, not only to get the fear built up, which I showed you last podcast. If you haven't seen it, go back and take a look at that. The fear isn't near as high as it was, the way I measure it, as it was back in early August when we just had a lot of panic. And you can see it just from the volume. You can see that big spike in volume. We're not getting that right now. In fact, the volume's getting weaker and weaker. Today was another weak volume day. Of course, Friday's in there with the half trading day, so that's you got to discount that. But what I would have liked to seen is we had this little left shoulder. Here's a little head here. It would have been nice to come back down into this area, right in here. And if we could have come down there and had the fear spike up really hard, I think then you would have seen the stock market really take off, and it could have been perhaps a nice December rally. And that would have been somewhere around 1135, 1140-ish, we'll call it. And we didn't get there. Now, it doesn't necessarily mean we won't get there, but when you have, we had, I think, 7 trading days in a row down. When you get that many days in a row going one direction, typical to have a bounce. You can see we had it here in early August, and then, of course, we just continued to fail. So today's internals, when you look at the market, when you look at the volume, when you look at the number of stocks participating, when you look at everything together, and by the way, if you look at what interest rates did late in the day, it says that it's an oversold rally, and it's nothing more than that at this point. And for those bulls, you want this to be the bottom. You want it to take back off again. But to me, we were setting up pretty nicely to get potentially a December or Christmas rally. And the markets were so oversold that you would expect that. We come in this morning, the market's gap open about 300 points, and pretty much stayed all day. Late in the day, the last hour, gave away about 100 of those points, and then got it back towards the close. So we didn't finish on the highs. Still a 90% upside day. But what would be a nicer setup is if we get the market to come back down to this lower base, and then you can get some type of potential for a rally that could last a while. So for right now, when you have this gap, most of the people I talk to that are traders in this market, they are simply not buying this rally just yet, and I'm not either. So for the last several days, having a lot of cash, getting stopped out on some things when it broke that wedge, that's still the right place and the right way to play this. And in fact, whether it's the 50-day moving average, which is turning down now, the markets may have some trouble going above that. That's something to keep an eye on. But again, if you want to participate, if the markets do come back, let's say it gives back a little bit of this gain, and it's on really low volume tomorrow, then you could be able to set something up to where we could have a potential tradable rally. But when you come in and you have that big a gap and you have stocks up 6, 7, 8%, it makes it difficult to jump on board. And so most people that I know didn't do much today. And those are pretty much the people that have been out of the market for most of this downturn the last couple of weeks. And I've been, as I've said on here, been extremely heavy cash, and I still plan on being that way. And I think you can do some trades. And there are a few trades that are setting up nicely, but overall, with the overall market right now, this is still going to be a tough time. We could have some return chasing going on, some people that are really wanting to have a positive year, and a lot of hedge funds are still down quite a bit for the year. So that could push the markets up through December, and that wouldn't necessarily surprise me. But if you keep an eye on the bigger picture here, this market continues to deteriorate, and it really does go back to the the June time frame when we bounced off the 200-day moving average. Then we broke through it right about here, and then of course we couldn't get back through it. So that now you got this descending line that now becomes potentially the area that the stock market continues to trade in for the rest of the year, and it has trouble going through that. We're going to take a look at Apple. I think a lot of people give me a lot of questions on Apple. I remain long Apple. I've been long for well over a year, and it's one of those stocks that I think you have to give it a little more leadway than you would a lot of other companies. Number one, this isn't a .com stock with a 90 PE. This is a company that's generating tons of free cash flow. They have a ton of cash sitting on the books, ready to either pay a dividend, make an acquisition, reinvest in themselves, and do something productive with the money. I prefer that they don't pay a dividend. And for those that have been following the podcast and me for a while, you know that I'm not a big proponent of companies that are in this growth phase, kind of getting to the point where they feel like they have to pay a dividend because they don't have anything else to do with the money. It's not real productive for them to make the money, send it to you and we have pay taxes on that. It's not productive. We want to see Apple reinvest and do something productive with that money. It's going to make more money on our money invested in them. I don't want it back. If I want a dividend yield, I can go to the Coca-Colas, I can go to the Microsofts, I can go to the pharmaceutical companies, the Verizons, plenty of companies that have dividends for years and are increasing them. That's fine. I can go to the master limited partnerships if we want income. But for Apple, I'm buying it because I want the growth, and I don't need the income from this stock. Now, it was getting a lot of publicity lately. Of course, they missed earnings expectations, and the stock gapped down. That was back in October right here. And then, of course, they fell below their 50-day. Here comes the 200-day moving average. And it's bounced off of it for now. So we're looking at this, and it's got some nice support. You can see it kind of in this 360 to 370 range. The stock has had some nice support. We didn't see overwhelming volume today by any means, and so for the Apple bulls, that's not necessarily a good sign to see that. But again, I think what happens is in bear markets, which I believe we're in, and by the way, the action that we saw in October and the action that we saw today, meaning these very strong, powerful rallies, are bear market type rallies. When you come out and you have a rumor of something and the stock market jumps up 300 points, low volume, no oomph behind it. That's more typical of a bear market rally. But in bear markets, assuming we're in one, what happens is eventually the good companies get taken out. In other words, everything gets taken out eventually. And people start to sell what they want to sell. And as the bull market progresses and the liquidations come in for mutual funds, they start having to sell the things that they didn't want to sell, but they have to sell. And that's Apple right now. So that's, if you've got your list of 50 stocks and you're wanting to sell some of them, Apple is probably at the bottom of the list of things you want to sell. Or another way to look at it is if you're wanting to protect some profits in a stock, that's another reason that people would go in there and start to sell Apple. But regardless, go back to 2008 and you will see that good companies, recession-proof companies, right? The Coca-Colas got hammered. A lot of these companies that you would have thought would have been okay in 2008 weren't. And that's what we're starting to see now. So we may have seen the top at what was the high? Around 428 or so, 426, 427 was the high back in October. Maybe that is the high. But I think this is the more important picture. This is the weekly picture. And you can see a definite, this is the 50-week moving average, and you can see this is the line in the sand. I think if you're somebody that is a little gun-shy, where should I sell Apple? I like Apple, but there is a place I would sell it. Where would it be? It's pretty close right now, but it's got a little bit to go, maybe the 360 range. It's bounced off of the 50-week moving average, and this really starts since the beginning of 2009. The stock was at around $80, and of course now it's at $380. It's had a very nice run in 2009, 10, and 11. But I think if this rolls over, then that's something you need to watch. One of the things that's concerning me when we look at this picture, though, is I've put the RSI, Relative Strength Index, and you can see it's starting to have this big, long negative divergence. And it's almost too long to scare me, but it's something that I do watch because what we want to see is this thing making higher highs, not lower highs. And that's what it's been doing now. You could argue, well, Carl, this thing's been making lower highs all the way since the middle of 2010, and the stock's up another $100 since then, $150. And that's true, and that's why I bring it to your attention, but it's not something necessarily that I'm terribly concerned about. I would be more concerned with moving averages crossing each other and some of these other indicators, but it's something to keep an eye on. So for the time being, I think this is kind of the line in the sand where it is. You've got this support. Of course, it broke through, and then it bounced off. Is it bouncing off right now? So we're at kind of a critical place. And I think you need to make a decision. Is this a stock that you're going to keep for the long run and based purely on fundamentals, or is it a stock that you're trading? Or C, is it a combination of both? Is it a stock that you say, you know what, I love Apple, I'd love to keep it, but I'm willing to get rid of it at least for a few months if the price looks like it's going lower. So I think that kind of 360 range is the line in the sand, and if it crosses down through this moving average, that's the point that we could see some more selling come in and really push this thing down much further into the high 200s, and then we could reestablish a new basis at that point. So it's a stock I own, but I'm not married to any stock, especially if we're entering a bear market. So I'm going to show you, we'll kind of call this the screen of the day, I guess, but I know a lot of you are looking for companies that have big dividends, and I think more importantly, companies that can show that they can keep their dividend and increase it. I think you'll see that the returns over the long run for companies that increase their dividends is more important than just companies that have big dividends. I think sometimes these companies that have these really large dividends, it's sometimes they can cannibalize, so to speak, and maybe the dividend's not sustainable. I think case in point was BP during the oil spill. A lot of people said, but this stock has such a great dividend, and now it's even bigger because the price has dropped. And one thing I pointed out in one of the podcasts was that the fact that they could cut the dividend or eliminate it, which they did. They have since reinstated it, but they did eliminate it. And so be careful because this is not a bond. So dividends can be changed. So when you're looking for a company with income, I like ones that can show that they can increase it and have sustainability. But for the screen of the day, I think this is for those that want this is the biggest companies with the biggest dividends. So I've got these ranked by market cap. So you got AT&T and Pfizer, Philip Morris, Merck, Verizon, Altria, all in the 4 to 6% range on dividends. And maybe some that you didn't realize that were up there. Companies like Freeport-McMoRan is in this group. And you'll notice Southern Copper's in here. You'll notice a lot of tobacco companies, utilities, and telecommunications companies, and drug companies. Those are companies that are in non-cyclical businesses, except for when we look at something like a Freeport-McMoRan. But a lot of these companies are companies you've heard of, and if you want big dividends, these are the latest ones and the biggest of the bunch. So again, not fly-by-night companies that have these crazy 18% dividends and something's goofy on it and it's temporary, but a company that is a big established company that's going to be there through thick and thin and has that dividend yield. And if you want to obviously add some extra yield, for those of you who like to do options, you can do that as well, and that adds a little extra yield on top of that. So anyways, I'll try to do some more of these types of screens. We'll start with something real basic and simple, probably one you could do on your own, but these are the big companies with the biggest dividends. All right, guys, don't forget, I'm on Google+, plus Carl Eggers. I'm also on Twitter, twitter.com/Carl Eggers. And, of course, carleggers.com is the blog. Hopefully you're signed up for that, getting these updates regularly. It's up at the top right for a free subscription. And eggerscapital.com is the money management website. Thank you for the support. Thank you for the comments and the emails, and try to get back to every one of them as I can. So keep those coming, and let me know what you'd like to see on the podcast or on the blogs as well. Thanks a lot. We'll talk to you soon.